Oh, look,
Not
I can. She
one
gives me the account owner is watching you.
word.
Leave now. Russian spies are upon you. Yeah, I think that, the biggest thing is kind of like you said. I think the number one thing with the interest rates is I would venture to say that like 80% of your first time home buyers just have no clue. It's just they meet a realtor. What are you looking for? What are you pre-approved for? Right? What did your bank tell you that you can go after? And then from there you start showing houses and they buy them. I just don't think that there's no sophistication behind an interest rate. I mean, I've seen people buy, this is no lie. One of the guys that used to work for me in my previous company, hired him straight out of college. He came in and wanted an offer letter. And we were kind of like, we don't do offer letters. Not really, it's not really what we do. It's like, so why?
Yeah.
It's like, it's one of those things where it's like, like we don't develop job descriptions. We just do work around here. And obviously we've since changed. But yeah, it's kind of one of those things where you kind of scratch your head. So I asked, I was like, what do you want it for? And he's like, I'm going to take it to the car dealership and I'm going to show them that I have an income to buy my truck. And I was like, oh, well, that's a great answer. Here's your offer. And I think we were paying him like 60 grand or something, 50 grand. I forget what it was. But he came back and I asked him about that car loan. I was like, hey, you didn't have any money to put down on it. How did it go? And he said, yeah, no, they knocked off like 5 grand. He was super excited, super pumped. Thought he had a great deal. It was like 9.5% interest. I was just, I was
Nine
just
and a
like,
half percent.
I just walked away. I mean, there was just no point. There was no point in saying anything because it didn't matter. But it was, yeah, that was the truth. And they had done what typical car salesmen do, which is, I'm going to take a couple grand off. You don't have any money. We're not going to take anything down. You got this letter, kind of making you feel like I'm doing you a favor.
Yeah.
Like, hey man, I got you back here. And then on
Holy
the back
hell.
end, yeah, they just stuck it to him. And I'm like, and that's the thing is like he is completely blind, no clue, doesn't even care. I said I could pay $350 a month. You came in at $350 a month, and I'm off and I'm happy.
And you have a
So,
new truck. Yeah, no
and I got a
kidding.
new truck. Yeah, yeah. So I think that's kind of the point behind the first time home buyer with the interest rate. I just don't think it's going to matter to them a whole lot. I think they're going to find that rate that they need from a payment standpoint per month based on what they can finance. And I think the interest rate's kind of arbitrary at that point.
So with that in mind, everybody's always saying, and to some degree, I do agree, right, that with rising interest rates, homes become even less and less affordable, and so prices usually need to reflect that with a decrease or maybe at least less demand. But rates have increased almost 2% in the last 6 months to a year, and demand seems to not even have been touched. It just seems to just be getting hotter.
Yeah,
Um, and now we're at, I think, 4.4% almost. When in 2 years ago you could get a 15-year fixed rate for like 2.1, which is just beyond cheap. And I don't know. I mean, how do you see it affecting demand and like and maybe even in the investor pool? I don't see it affecting the investor pool at all, to be honest with you. But how do you see it affecting the affordability and demand of the housing? Just because I mean, if on $1 million mortgage, if you're at 2.21 and 4.5, I mean that's a huge shift.
yeah. I think that there's a lot of macroeconomic levers in that equation. And that's how I look at this stuff. Is there's a ton of variables inside an equation that equal, you know, I guess demand. And so one of the big ones that I was talking to our banker and that we do a lot of this work with, and he was telling us that just by standard attrition, their business at the bank is shrinking because of the baby boomers and how many of them are getting out of, business deals in general. And the bulk of their business is now moving more towards deposit accounts and less towards loans. Well, they don't make any money on deposit accounts and they have $100 million sitting in the bank, but that's not doing anything.
Right.
With inflation is shrinking, and so they are very aggressive trying to go after investors and guys that want to lend money because they need to lend money. And so, that therefore squeezes the rate down. But it's also, when we talk about the Fed raising interest rate, they're raising their interest rate. But if you want to do internal loan products at the bank, they can kind of dictate. Obviously, they're going to go off what the market rate is, but they can still squeeze that margin down because they're not borrowing it themselves. They've just got a ton of deposit accounts.
Right.
So that's been one of the things I've experienced on the investor side is that there's an opportunity there to not sell off to the secondary market. I'd be worse off trying to sell off to the secondary market. So it depends on your strategy, depends on what you're going after. In terms of like demand, I think it depends on the market that you're after. If it's like, small single family homes, or if it's, multifamily or land or something like that. Because a lot of these larger REITs and private equity, they can do non-recourse debt and they can put some serious money. They have a lot of dry powder out there, and they can, kind of like a brokerage account where you can borrow against it and borrow a margin
Right.
and leave that money invested. There's just so many different, I guess financial tools that you can use that the interest rates aren't gonna hurt you. But the thing is like the good thing for an investor, right, is you want to buy when interest rates are high, which is kind of counterintuitive what most people think. But the purpose of that statement is that when interest rates are high, value is low. And so the thing is that whenever that equation gets swapped and interest rates are low, value's high. So if you got the cash, then you go out, wait till they keep raising these interest rates, wait till demand falls a little bit, which it will. Even if it knocks off 10% of it, it's going to fall some. So buy it at the 5.5% interest rate, lock it in. And then whenever the interest rates drop, like they always do, and the value skyrockets, go get it reappraised and refinance it. Cash out your money and then lock in a 2.5% interest rate. And that's kind of what you're seeing. It's kind of like that house that I have in Bryan, right? Could easily sell it and pocket what, 50, 80, 100 grand. But it's like, I have it locked in at 2.5%. Why would I ever get rid of it? I don't need the money. So why sell it? And I think that's part of the reason why we're seeing demand stay where it is because it's not that demand is constant, it's that supply is so small, right? And so I think that until the builders, and I feel bad for any home builder on planet Earth, finishing mine, I've told myself it's the last thing I'm ever going to do is become a home builder. There's no way, no way. But no, I think that's kind of my theory on it, I guess.
I gotcha. Um, and how do you see, especially with supply being so low, and I've met with 6 or 7 different home builders in the last month or two, and every single one is telling us, "Hey, we don't have anything for at least 3 to 4 months, and then if you want something in 3 to 4 months, you better get on it now because it will be gone."
Mm.
And I mean, they're selling stuff as soon as framing goes up. I mean,
Yeah.
it's not even close to being done. And people are paying stupid prices for houses that 2 years ago were going to be $75,000 less than what they are now. And it's just kind of nuts to me. So whenever rates rise and they hit those new builder homes, and your mortgage payment is $2,000 on a 1,200 square foot house, I mean, where's the fine line between, okay, this is just really overpaying and I'm overpaying every month, or maybe it's not because they're approved for the loan, they have their debt to income ratios, and they can afford to pay it. Whether or not the value is there, I don't know.
Yeah,
It's just interesting to me.
it kind of goes to Ray Dalio's book where when you're caught in this cycle and people are willing to just accept less, the quality of life is willing to go down. So they're willing to pay more for a lower quality of life, right? The only other thing you can do is rent. Because like you said, it's like the problem with the rising of the interest rate, because I don't necessarily agree with it, the Fed stance on, inflation is going up, we have to tame it, which traditionally is rising interest rates, which will work because what we're experiencing is extremely difficult supply chain constraints. And like this week, dude, we got an email that steel is going up 32% over the next month. 32%. Yeah, and I
32.
mean, we buy a massive amount of steel. And I mean, that's just huge. It's massive. 40%, 50% of our projects are material. And
Right.
so it's just crazy to think that that's how. So we're calling everybody and their dog, locking in prices, trying to order stuff ahead of time, which therefore puts a supply constraint on it. So now you're just playing this game of commodities that are going up and down. And so that's my problem with interest rates is interest rates is a very stagnant common thing, right? It's not like a commodity. But really, our problem is our supply chains. And with the war in Ukraine, it's like with wheat and all, it's like stuff is going to continue to go up and down sharply, like we're not used to. And I think the Fed's got a good approach. They're not, they didn't come out and say, "Hey, I'm going to stick it at 7%." They raised it what, like 250 basis points or something, and they're
Yeah.
saying they're going to do that over the next, 3 or 4 times over the next year. At the end of the day, that's a very slow, methodical method. But they've got to get the supply chain worked out. And by raising interest rates, lowering demand, the supply chain should feel some easing to it, right? But the supply chain is so messed up. And this, they call it like on time demand or endpoint or vertical integrations, all this stuff with this warehousing. And we're doing a ton of the work. We were such a globalized economy that whenever you throw a kink in that system, it just fell apart. It was a house of cards.
Right.
So now we're moving back towards a national economy where we're trying to manufacture, but that takes time. I mean, you can't just snap your fingers and build a 1 million square foot building. It
Right.
just you just can't. And so I forget what your original question actually was. I just go on my random tangents, but
Well,
um,
no, I think we can roll we can roll into that. What so instead of like rising rates, because
yeah,
um, obviously it's gonna be a big factor, but you're so that and then the reason we're talking about rates is because of inflation's super high.
right,
But it's sort of sounding like inflation isn't crazy high because of the low interest rates, right? It's because of all these other factors that are going into it. So how do you fix the supply chain issue? I mean, I'm sure it's an insanely logistical nightmare, but
yeah.
how do you fix it?
I think it's a magnitude of things. I think obviously one is demand, right? You don't have a supply chain problem if you can lower demand, but that's kind of counterintuitive because now your economy is not necessarily growing, right? And so in times of growth, you want to kind of feed that growth. You don't want it to get too hot, right? But you want to feed it. But we're in such a geopolitical, we're just kind of in a weird spot where we're just kind of we don't really know, and we don't know what Russia's going to do in Ukraine, and are they going to use nuclear weapons? They're going to use biochemical weapons, and then they've yet to figure out. And it's funny because as America, we feel like we're the schoolyard police, where we have to oversee stuff and kind of have our hand in everything. And I read that wheat is 15% of the overall caloric intake of the world, and Ukraine being the largest producer of wheat. And what do you think that farmer's doing? That right now is planting season. He's not planting wheat, right? And so it's like you think right now is bad. Wait till next year when there's zero. You know what I mean? And it's like, how are we contingency planning for that? And I think a lot of the resources are going to that. How do we contingency plan? How do we have backups in place? Um, and so I think the only answer to the supply chain issue is to lower demand at some point because we just can't fix it right now. We can't figure it out. They've proven that. There's so much things they can do with the ports. Obviously, with fuel going up, fuel is a part of the entire logistical food chain, and people have no idea how many times. Like if you just take that podcast speaker you have right there. I mean, it was manufactured somewhere, it was shipped somewhere, it was assembled, it was painted, it was put in packaging, it went to an Amazon warehouse, which probably went to another Amazon warehouse, which then you ordered it, which went to a UPS or something. It's like there's so much fuel involved in that equation. Um, it's like the only way to do it is now they're going to have to add that surcharge. I mean, we added a surcharge to all of our stuff. We had to. Fuel is just absolutely clobbering people, and so therefore that's going to raise inflation of all goods. Everything that has to get transported, which the only thing that I'm aware of in this entire house that hasn't touched an 18 wheeler is probably the water that comes out of the faucet. Everything else has touched an 18 wheeler at one point in its life cycle, and so Those guys are bearing the burden. I got a buddy that owns a trucking company, and he sent me a picture of one of the trucks, and I think it was like $2,500 every 4 days for one truck. For one, I think he has 10. And it's
Holy
like, oh
crap.
my God. I mean, imagine the cash flow on that. You know what I mean? And so, in order to fix the supply chain issue, that's a long-term answer. The easy short-term one is to do what they're trying to do, which is slow down demand. Uh, but like for the houses, I just think that people are going to have to be willing to accept less, which is not good. It's like whereas a $300,000 home, and obviously it's all geographical, but $300,000 home could be 1,800 square feet. Well, now that same home is 1,200 square feet, but it still costs $300,000 legitimately because of all the product that went in it. It
Right.
went from 130 to $150 a square foot. Concrete went up. I mean, imagine the steel rebar, woods through the roof, and then labor on top of that. It's always a bad thing whenever you can't find anybody to work, and when you do find them, they're not even appreciative. They're just kind of like, whatever. Um, it won't be that way forever, right? It's going to have to slow down, and it's just a matter of when.
So what do you think is the reason that people aren't appreciative of it? Is it just because all the money's been handed out, or what?
Yeah, it's just there's too much opportunity out there, and that's good. I mean, wages rising, but when wages rise right along with inflation, what's the point? Yeah, it doesn't do you any good. Um, so just because you got a $5 an hour raise and everything's at 7% inflation and gas doubled, you know, I mean, and that's the fuel is the one that's hurting people the worst, I would say, and it's also going to just it's one of those indicators, one of those commodities that's so embedded in the entire economy that, as it doubles and rises in rate, everything is going to be affected with inflation by just it. It's a large variable equation.
Right. Right. It's definitely a very complex issue. And it just seems like most people put blanket statements on it. Which I don't think is very good because I think it's a lot more in depth than that, which it is. But I just don't know if most people even think that far into it. It's like, oh, gas prices are rising. It's like inflation sucks. Well, I mean, it's like you got to think a little bit deeper than that. Um, but I saw
And
on
there's
I saw on Bloomberg the other day, and I'm curious to see what your take on this is. Um, I saw on Bloomberg the other day that they were talking stagflation. Um, what do you think could be the scenario where that ends up happening?
so explain to everybody what stagflation is.
So I don't have much experience on that, but essentially, I read that it's almost like just like you're not growing, but you're not declining. Essentially, you're kind of just maintaining, and inflation is abnormally high for abnormally long time,
Right.
but not increasing. Right. If
Yeah.
that's wrong, correct me.
No, no, it's right. There's different like there's stagflation, inflation, and I forget what the other one they call it. It's some sort of minimalization and then inflation. However they want to phrase it. And so that other one that I can't think of the name of is where you're willing to accept less for more. And so the instance of that is like the potato chip bag, right? Where it's still, a dollar, right? So it's like, and then it goes to $1.09. It's like whatever, it's 9 cents. But then the amount of product inside it is 70% of what it was at a dollar. So therefore, they're trying to increase their margin and minimalize markup, but you don't even recognize it. And it's the same thing with the housing market. It's like they're going to build smaller houses with larger prices, but you're just kind of going to have to accept it because it is what it is, right? Oh, it's shrinkflation. That's what it's called.
Hmm.
Shrinkflation. Yeah, I'll have to write that one down. So yeah, my understanding of stagflation is where, like you said, the economy kind of stays where it's at, but prices rise. And I think we're in shrinkflation, or I think that's kind of what's going on. Is people, they're just kind of settling with it is what it is, kind of like the commodity of steel at our company. It's like, it's just what are you going to do? It is what it is. You know what I mean? And so we're not able to. I guess that is a form of stagflation. There, we can't go down, right? We can't minimize pipe pricing or minimize pipe sizing. Hydraulics is what it is. I can't I can't recreate Darcy Weibach's equation, unfortunately. And so it's like that is a form of stagflation. You're getting the exact same product, but it's just going to cost you 30% more.
Right.
But I do think that there's going to be an element of shrinkflation. But then, that kind of puts this weird spin on what you consider supply and demand, because demand's going to stay constant or even go up. But yet, that when shrinkflation occurs, it's like, man, everybody wants something, but they're willing to pay more for less.
Yeah.
And it's kind of that just gives you this weird feeling. It's kind of why the RV boom is here. I mean, last year we took the owners of RV Station, or one of them, I guess. We're sitting down and having a conversation, and they said, I think they said on average, they have 7 locations, and they were selling on average like 52 a month per location, RVs. Then and I've got guys that work for us that just can't afford a house, so they just buy an RV, go park at an RV park.
Yeah.
But, therefore now it goes back to the problem that I see where, and I know we've talked about this before, where the best part of America's economy has been home ownership and home equity. And that's how they build equity. And then that thing appreciates in value. And then eventually, whenever they go retire, they've got this nice, pretty asset and this goose egg sitting there that they like, that they can sell or borrow against or something to
Right.
finance the retirement. If that starts to go away, it's a long-term problem, right? It's a 20 or 30-year away problem. But you've got the exchange of wealth from all the baby boomers. I mean, I look at buying a lot of businesses and sit in on a lot of meetings, and there's a ton of baby boomers right now that are offloading all their companies. And a lot of it's due to they just tired of dealing with millennials and Gen Zs and beanbags all day. Um, but a lot of them do want to retire, and that's where a lot of people are getting the capital to come in. But yeah, I think shrinkflation is probably more prominent in my opinion than stagflation. Um,
That makes
which is
sense. That makes
yeah,
sense.
yeah,
And I think that sheds a light more on, and maybe it's not even like, well, I don't know. I guess it is, but the demand is so high. But the
mhm,
demand is so high because, the replacement cost has just skyrocketed because of material costs to build houses. So when you see these new builds over here that are 1,200 square feet listed at $300,000, well, that gives an excuse for the realtor to list his 1,400 square foot house at 260 when last year it was 220 because,
mhm.
oh, look, that's a deal compared to that new build.
Yeah.
And
I also think a lot of it is
everybody's hitting it.
yeah, like I've got 3 friends that all work for me that are all sitting on the sideline looking to buy a house. Right. But they've been holding out for well over a year now on waiting for the market to correct, or let me see what this all this stuff. And so wait, wait, wait. Well, eventually you get tired of waiting. Right. So at some point you're gonna have to pull the trigger. And I think that's where that shrinkflation occurs, is it's like, all right, this just isn't going to change. I can't afford what I thought I could afford. So I'm going to go buy this smaller 3.2 that's 1,200 square feet instead of 1,800 square feet. And I'm just going to make it work. And it's going to cost me $280,000. It is what it is.
Right.
And that's the element of shrinkflation. Um, but I don't know. I don't hate it. I think that it does a lot of weird stuff to the economy because we buy so much crap. That's why self storage does so well. Um, I loved moving because I threw away half of my stuff that doesn't get touched. But by having smaller houses and stuff, you can fit less in it, and it just has this epic effect on the economy. But I don't. Have you ever heard of the marketing scheme of like how they try and make you get a divorce? Have you ever?
No, I haven't.
It's pretty interesting. So the goal of, and this is a blanket statement that's probably not fair for most marketing people, but so if you take a couch, for instance, who manufactures couches?
I don't
Ashley
know.
Furniture. Give me a name, whatever. It is what it is. We'll just say Jake's Furniture Store. You're better off if that family is split up, because now they have to have 2 couches, and they have to have 2 houses, and they have to have 2 TVs and 2 refrigerators, and the kids have to have 2 sets of blankets and yada yada, right? So it kind of doubles the size of your economy.
And
And
multiply that by 300 million.
correct. And so I was reading a paper on that, on what it was trying to do. and how the marketing schemes and how they divide you and try and make you um, get a bless you get a divorce and split up and stuff because it does drive your economy. I mean, it's everything. It's two toasters. It's all of it. So it's a really interesting. And I think
Two
the other
insurance
thing we haven't.
policies.
I think the other thing we haven't really talked about is the work from home and just how much of a difference that's made for people to travel. And, I mean, I know that Google and a lot of the bigger companies are really trying to put a stand in place right now to bring them back to the office. But, that's either going to work or it's not. And I'm curious to see how it plays out over the next 6 months. Um, I personally think hybrid's here to stay. I don't think remote working works that well. I don't think you build relationships and camaraderie and work your way up in a business if you can't be there at least some part of the time. But I do think hybrid is permanent. I think that you're no longer going to have to work from. I mean, we banned buying desktops when this company first bought my business and I joined it. They wouldn't buy us laptops.
Really?
Well, now, yeah, within 12 months, I sold last January. Within 12 months, they have 100% banned desktops, and all they buy is laptops. That's what this is that I'm on right now
Huh.
because
Interesting.
of that shift. You know what I mean? So
Right.
it's here. They know it. It's just clunky. They don't make laptops to run the kind of software AutoCAD we have to run, but this thing weighs like 30 pounds. I bet it's a brick. But
Well, that's
yeah,
like, oh, keep going. I'm thinking about this.
yeah, I think that the work from home stuff goes back to kind of like here at my new place. It's like you have to build in an office. You have to build a bigger, larger square footage. You want that office to be able to be separated from the rest of the workspace or the rest of the house because you don't want to have to listen to the TV or to the kids playing or whatever it is. You need to be isolated, and now you need higher internet speeds, and then now you really care a little bit more about your home because you're there all the time. And so, maybe pay attention to detail a little bit more, do some home remodeling and stuff, and which is why you see like Lowe's and Home Depot and their sales are off the charts. But it just tanks commercial real estate, right? So your office real estate's been getting hammered, and I think it's going to continue to get hammered because if you're not going to be there, but 70% of what you were, well, you might need a little bit less space, right? And then you don't need all those pictures of your kids and everything because you're going to be at home more, right? And
Right.
there's your pictures. And so, there's just it just takes the economy, and it's like I've always said, it just takes all the predictors and the factors and shakes them up and discombobulates them. But office warehouse spacing or warehouse in general is just booming, and it's going to continue to boom because of the national economy, right? Trying to bring things back to the house and store more stuff. They were doing endpoint demand or on point demand where they were really never storing it. It was just kind of moving along the logistical supply chain kind of all the time. I mean, obviously Amazon has big warehouses, but they weren't storing stuff for months.
Right.
Well, now they're getting as much stock as they can and they're just storing it. And then they're, selling it as they can because the supply chain is so backed up and they kind of see that. So yeah, it's
One thing that I've seen with the work from home stuff, I've seen a lot of people, and I see this in mostly bigger cities, but I've seen a lot of people be like, "Hey, screw it. I will work for less money. I will make less money if I can live my life the way I want to." AKA, before COVID, they work in an office job. They got laid off. They had to go do something to make some money, whether it be Uber, Lyft, go shopping for other people, shipped, favor, whatnot, what have you. And I've talked to so many Uber drivers who, and that I guess that's a form of at home work. It's not at home, but it's
yeah,
not an office for sure.
100% your own time.
And I've heard people that say, "Hey, I made 70,000 in the office, but now I make 55, but I only have to work 60% of the time, and I get to work whenever I want, and so I'm going to do it no matter
Yep.
what. I don't care." And I think we're also going to where people, like you said, people are going to take less. Now that's not necessarily taking less or getting less for more, but they're willing to take less because they don't want to be constricted and controlled.
Yeah, I think a lot of people, and this is where like, Social Security came from, right? A lot of people just want to make the ends meet at the end of the month. and they don't necessarily plan ahead for retirement and all this stuff, right? And that's okay. I mean, that's kind of the American way. Is like some people, it's your choice, right? If you want to be an investor, be an investor. If you want to go work hard, work hard. If you don't, great. But that economy is called the gig economy, and it's taking workers out of the workforce that they whereas they would have had to go get a legitimate, skillful job, right, as a waitress or working in construction or whatever it may be. They're now able to drive an Uber, right? And like you said, and at the end of the month, as long as they can make two ends meet and all their bills are paid, they're happy. And they don't. But the moment their car engine blows up or something drastic happens, they're in a bind. But at the end of the day, that's not their problem. They don't care. They're just kind of like, yeah, whatever. And that's why I said that's where Social Security comes from, is because that's what at the end of the day, that's what that retirement is supposed to be, is they can at least get a Social Security check or something. It's a great theory, right? It was not. It was intended to be well. I don't think they executed as greatly as they could. It's hard to do something when you borrow 80% of the money of the value and then you can't pay it back. It's tough to continue to supply that, but that's a different story. So yeah, I think that's one of the bigger problems there. But it goes back to, I like the word or the term shrinkflation. People are willing to pay more and accept less, and I think that's just kind of the world. I don't see that going away. I think that's going to be something we're going to continue to do. Is pay more for less.
Yeah, that is interesting. And like you said, they they're at home more, so they're going to be in tune with, oh wait, this couch kind of sucks, and oh wait, I don't like seeing these crappy walls, and maybe I want a little bit better space to live, and that's why was Home Depot and Lowe's was going crazy during the pandemic.
Yeah, I want to talk about the Troy stole my thunder, my 40-year mortgage rate on Facebook, but
I'm pretty sure I told you that one of these days too.
come on. I don't remember where I heard it, but it goes back to like Japan, and I like looking at other countries that have had slowing economic cycles and inflation and things like Venezuela, and how are they handling it, right? It's kind of a predictor. The problem is, and this is the problem I have with Ray Dalio's book and all that stuff, is that we are the reserve currency of the world, and you've heard my theory on digital, uh, what do they call it? U.S. digital coin.
USDC, yeah,
Yeah,
yeah.
they can come up with a better term. The digital yuan sounds cool.
They
USD. I guess USDC doesn't sound too
just say
good.
digital dollar.
Digital dollar. Yeah, I like that. That'll work. I think that'll come out soon, and I just think that being the reserve currency of the world, that status puts you in a different league of financial levers. And whereas most countries pull financial levers and it puts them in a spiraling, down spiral, it just doesn't work that way with us, because it's the reserve currency of the world. If China and Russia do business, sometimes they do it in dollars. They probably don't do it anymore. Um, but so I don't think that his book is predictive of how this cookie is going to crumble. But I do think that the goal of the 40-year mortgage, or if they were going to repay student loans and stuff like that, is to put more money in the average American's hand, right, and then allow them to spend, which is the money velocity, which is what stifles or stimulates the economy. And it's kind of like the stimulus checks, right? The reason why they did, or where I think they did, the stimulus checks versus like air quote bailouts, is now you let capitalism run its course. So by giving all of your people money, they get to decide. They decide, they vote with their dollars on where they want capitalists to prevail, right? Whether that's painting the new wall or buying the new set of tires or whatever it is. The government would have never been able to spend that money in the same sense that all the people could, right? Unfortunately, I didn't get any stimulus checks, so I couldn't partake in that. Um, I would have cashed the shit out of it if they'd have given me one. I know a lot of guys that were like, "Oh, I burned mine." I'm like, you give me 5 grand, I'm done. Yeah, I might as well. I got to pay for it anyway.
No kidding.
But yeah, I think the 40-year mortgages. I think the student loan. They keep kicking the can. Is it even enacted yet, or is it June or something like that till you have to pay it back?
What do you mean?
The student loan repayment, is it still
Oh, it's
paused?
they're it's still paused. Yeah,
Still
still
paused.
paused.
Okay. Yeah. I mean, that's another one. That right there will hurt worse and hurt demand more than raising interest rates. Because I mean, the average student loan, I think it's like $400 a month. And so when you kick
Yeah.
that thing back in line, there goes $400 a month out of your largest buying pool, right? Because it's all of your millennials. They're the ones that are moving and buying houses and getting out of the cities and doing all that stuff right now. And they're the ones we are the ones with all the student loan debt. Um, so that's going to be a big factor. But I think the 40-year mortgages is something that's coming. Um, at the end of the day, I'm not opposed to it. I think that it lowers that, but that goes right back to shrinkflation. You know what I mean? It's like
Yeah. Yeah.
you're getting the same thing, but you're paying less or paying more for it over a longer time. But it's skewed in a mindset where you're paying less.
Yeah. Yeah. So
They,
I'm doing the mortgage payments on $400,000, 20% down, at 4% interest right now, between 30 and 40 years. So 40 years is about $1,700 a month at a $400,000 payment, right? Which is not bad. And that's,
no,
I mean, you go pay $1,700 a month in rent, and you're probably renting a $275,000 house right now, or a $300,000 house, right? So if you can go put some money down and buy a $400,000 house, why wouldn't you?
right,
As opposed to a 30-year mortgage, I don't think it's actually that crazy different, but you're paying an extra $200 a month, so it's 1,906. You're actually paying an extra $200 a month, um, which could make or break some people in debt to
yeah,
income. So, I mean, it makes sense. And most people aren't gonna worry about, oh, is it 40 or 30 years? I don't care.
no,
What's the payment?
right.
No.
It's the same thing with cars. I mean, I remember way back in the day, they used to sell them at, 3. And if you got a 4-year car note, that was a big deal. That was a long time. And then it
Now
went
we're
to
at
5.
7.
I was going to say, yeah, what is it, 7 or 8 now? Like it's like, which, then again, now they'll last longer, they're built better. So, um, but yeah, they keep, that is an instance of stagflation. You get the same product and you drag it out over a longer period of time or pay more for it. Um,
Well, so
you know,
I saw that investor, this because this could go all the way into in the investing side. I saw an investor that got he got a loan for 35 years fixed at 2.5% interest, and I'm sure that was some type of bank product that they offered, but it's just interesting. That's going to be a big pull, I would think, for investors to go a 40-year route instead of a 20-year route, because they're, if all you worry about is cash flow, well, then if I can increase my cash flow for another 10%,
yeah.
and I'm not worried about the equity right now, well, then let's do it.
I don't know if they're going to be able to do that. Because in my mind, if they're going to do the 40-year, it's going to have to be Freddie and Fannie at the Fed level. And we have hell. I mean, as an investor, I hate Freddie and Fannie, or they hate me, I guess is the way to put it. I love them, and I would give them a big hug, but they don't like me. Because that's all they care about is debt to income, or they would just, and it's like at some point the rat race is going to catch up with you, where you've got
Right.
too many properties and not enough income in their mind, right? Because they don't give you much credit for those properties in terms of leases and short-term rentals and all that stuff. And so I think that would be the one in my mind, right? If I was the one putting the policy in place, this is not for investors. It's for your average American that needs to get that $200 break.
Right.
Your other guys like me and your investors, it's like, we need access to what we have currently. And I think we're making it work. I mean, um, the goal is not to hold those properties for 30 years. That is just not. If you're still in the same asset class, or you're still dealing with the same money in 30 years that you are now, then you failed. You're not a very good investor. Uh, the goal would be to turn those things in the next 5 or 10 years, and then move on to bigger and better.
Right. Right. Maybe more better quality, and more cash flow. Because that's what I tell
Yeah,
everybody. I was like, even there's some houses that we have, that really aren't the best, but I'm like, this is not really the play right now. The play right now is for us to let the location develop. It's to pay the debt down with the rent. Not worried about making a bunch of money right now. And in 5 years, when I have $80,000 equity, or whatever it is, maybe $100,000, then I can either, hey, let's sell it, take that 100 grand, or we can 1031 that into a down payment on a $400,000 property, or $500,000 property. And now you're all of a sudden looking at, okay, instead of a little house that pulls in 2,000 a month, well, now you're looking at a place that pulls in 5,000 a month, and you're pushing a lot more weight, and then you have more equity there, and it just grows exponentially. And
Yeah, I think that
so
it's interesting to see how other investors look at stuff because I met with a guy, that big house that you and I looked at, right there behind Kyle Field. I know I told you the story
yep, yep,
on
yep, 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 yep.
it. So when we sat down and talked about price, it was just interesting to hear his methodology behind because it was negative cash flowing for him. But in his mind, he was winning because he took the balance sheet approach and he looked at the appreciation every year, which was 60 grand, and he was renting it for 7,000 a month. So 7 times 12, I mean, so he was, near $100,000. But in his mind, he was thinking that because what is 7 times 12? 84. So he's making 84,000 plus 60, so now he's at 144,000. And so now that does, if you were truly getting $144,000 in cash flow, now you're servicing the debt. But the 7,000 a month didn't even service the debt and taxes. But in his mind, it was a win. And it's just one of those things where, I mean, he's a seasoned investor, dude's worth plenty of money. That's just how he justified it in his own mind.
Yeah,
And then on top of that, you get to use the asset for what it was and everything. It was just an interesting. I remember sitting in that meeting, and a little light bulb went off, and it's like not everybody thinks like you do. Because in my mind, it's like it needs to cash flow, it needs to pay off its debt service, as well as produce a little bit of extra income. That would be great. But at the bare minimum, if it's not servicing its debt, then I mean, what's the point in owning it?
right.
But in his mind, he's got enough cash flow coming in from everything else that, you know what, I'll have that thing almost break even. I'll balance sheet approach it. It'll appreciate. And then one day I'll sell
Yeah,
it.
and then in 10 years you're up almost $1 million,
Oh, a
and you don't
ton.
even
Yeah.
care.
Oh, yeah. Yeah, so it's just interesting to see. It's like it's kind of like Troy and I were talking about selling the land in Iowa that we're working on, and we're going to sell the two left-hand plots first, right? The 6 and the 7 acre, and we're going to hold on to the 15. And I said, this is exactly what people do that really pissed me off, is because once we sell the two on the left, we're out of debt, right? We completely paid it all off. Well, now you can list the 15 at whatever you want. You can list it $30,000 an acre, and then
Right.
you just wait. And then when people try and send you lowball offers, and it's like, oh, it's been on the market for 100 days. This guy probably needs to sell it. It's like, I'll sit on it for 30 years. It's like, so, but that's the people that really irritate the shit out of me. It's like, well, why'd you list it then if you don't want to sell it? You know what I mean? So it's one of those things. But
Turn into your
yeah,
worst enemy.
right. Exactly. Exactly.
That's all
What
right.
else you got?
You got to play the game. You got to play the
Yeah.
game. I don't know. I think that's interesting because I've heard of another investor that has also done the same thing. He's actually doing majority uh, negative cash flow, and not, albeit not very much, but he's just investing based on appreciation, in very, very like A class neighborhoods, where maybe cash flow isn't great. Maybe the cash on cash return is not good at all. But
Yeah.
if it's increasing at 6-7% a year, and you're in 700,000 to $1 million properties, I mean, you're pushing a
Yeah.
great amount of return overall every single year.
Yeah. You just have to be careful with your buyer in that sense. That's kind of what, I've seen this happen in, Pebble Creek in South College Station over there. Really high end neighborhood, gated, yada yada, all the stuff. And their buyer pool is just limited. You know what I mean? There's just not many people that are going to go in there and drop $1.5 million on a house. And if you've got that kind of capital to drop, or if you can afford that, do you want a house that was built in 1990, right? Or do you want to go build your own because you've got plenty of money, and
Right.
the only thing that stops you there is time, right? Maybe you want it right now. And so I've seen houses sit on the market in that neighborhood, um, for a year, 2 years, you know what I mean? And just steadily drop in price because of that. And then they end up getting sold at what you would think is a discount, but it's kind of like, well, who's the buyer's market, right? I think if
Right.
you're building newer luxury homes, you're probably in a good market. But these older, when I say older, I'm talking like 80s to early 2000s, big $1 million homes. They just don't have the smart home technology capabilities, and they also weren't built the same with the open concepts and all that stuff. And so it's just interesting to see how some of those asset classes can actually get hurt. They might be big and cool and fancy, but they're just not the newer big and cool and fancy.
Right. Yeah. I don't think that's probably what he's even thinking about. I think he's thinking about more of cash flowing real estate that is just depreciating normally. I don't even think he's in that niche market. Um but yeah. Yeah,
Where do you
that's
think interest rates go by the end of the year? I mean, you think we see a sharp decline in, or you think demand begins to fall and then interest rates rise to 5.5? I mean, that's, what do you think?
they definitely could rise a little bit more, I think. Although if you look at the 5 year chart, they're already about to hit the high of 5 years.
Uh,
So it's not like in the 5 year span that they're low.
right,
In the 10 year span, they're not low either. They're just under what they were 10 years ago. Then if you look at the all chart, obviously they're very low.
right.
Um, so it's hard to tell. And I think it's a accumulation of everything we talked about. I think the supply is just not there. There's just nothing to buy, and when there is something to buy, it just goes insanely overpriced. And so I think everybody's getting used to these high prices, whether it's good or not. Um, and so people are going to be used to be paying, 5, 10,000 over for what they want, because it's not really okay. This is a great investment. That's what I want, right? I don't care. That's what I want. Um, and so I think they could go up, but with the fact in mind that the majority of people aren't even looking at that interest rate. They're looking at their payment. If the payment
Right.
works, whatever. Like, it doesn't matter to me. Then I think demand could stay the same unless rates just doubled. Right. If it goes from 4 to 8, well, then we have a problem. Right. That's a much bigger problem than oh, is the market going to crash? Because if you go to 8%, I mean, some shit's wrong.
Yeah,
Um,
I think that I think that's one of the issues too with shrinkflation that we were talking about. Now that I think about it, is like with these home builders. I look at like Stylecraft because that's the one that I know really well, and I know a lot of people that work there, and we do a lot of work with them. And they're not really building starter homes anymore. Like they're kind of like the DR Hortons. Where they're like this neighborhood they're doing out here in Iola. It's called Muirwood. I was talking to my buddy, and I was like, oh yeah, they're going to start around 300,000. He's like, they're going to start at 400,000, and I'm like, whoa, like that's you're just the first time home buyer, or the people that can't necessarily afford stuff like that. They're just kind of forced into that market of smaller, rundown homes, or flips and remodels, something like that, where they can get in where after you just flipped it, or kind of what you would consider your class B or C neighborhoods, even though they're not traditionally, they would have bought a newer home, a newer, smaller home. But those aren't being built. I don't, not anywhere that I've seen being nicer mid-tier homes.
yeah.
So I'm curious on what that does to your lower end market, on how that works.
Well, so
Um,
I think
yeah,
I think it's just a reality, especially here in Bryan College Station, that your first time home buyer, your starter home, quote unquote, it's no longer sub 200,000
no, no,
unless you're in
no,
North Bryan. Like, there's just not.
no. Yeah,
Your starter
I don't
home in
think
College Station is going to be approaching 300,000
yeah.
already. Um, and so I think those $400,000 ones is the ones they can build to actually make money, and I think they're forced to do that. They can't make money on $250,000 houses,
The margin's too small.
right? And so I think you're right. I think people are just gonna be forced to choose, either wait it out or make more money. I think that's about it.
And that was the problem with COVID, is that the waited out was much more painful because you were literally waiting at home. You know what I mean? You weren't traveling, you weren't able to go to work, there's all this stuff that you weren't able to do. And so you were just sitting at the house waiting. You know what I mean? And I think that's just, people are just so tired of waiting. But they're also reevaluating life. I mean, that's where the great resignation came from, and the turnover of employees and the lack of loyalty, and it's just insane right now. And it will eventually cool off. I mean, obviously the geopolitical world has a huge hand in it, and what Russia actually does, and China and all that. Um,
Yeah. Oh yeah.
but I think that it's an interesting time to keep tracking it, but I don't think it'll get to 8. I can see it getting above 5, maybe 5.5, and I think that's gonna really start to pain some people.
Oh
Um,
yeah, oh yeah. I mean, I 8 was just kind of a contrary number.
yeah.
But like, I just, I could actually see them, because they've spiked really, 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 really
Oh
fast
yeah.
in the past 2 months, and so I could see them spiking even higher, sort of like what happened with oil. Like oil just rocketed to the sky, and
Hmm.
then it hit like $135, $140, and just now, I mean, I think it hit like 98, but $98 last week.
Yeah.
It just crashed pretty hard. I think that we could probably see something like that. It's just kind of a slight overreaction to the upside, um, and then maybe
Oil's
just a
just
cool off of a little bit higher.
oil's just one of those commodities, and that's the problem with OPEC is that there's so much control there, and there's so much geopolitical risk and geopolitical controversy because it is the number one telltale of all commodities on the planet, right? And Saudi Arabia can turn the spigot on anytime they feel like it,
Right.
right? They've got that capacity to do that very, very quickly. Um, but everybody knows that oil is what is the underlying driver of inflation, and we already have a problem with inflation. And so I'll be surprised if they can't cut some sort of deal because they can turn the spigot up on OPEC. We can start producing a little bit more here and pretty much shut Russia out, but Russia is selling oil on the, let's call it the black market at 40, $50 a barrel, half of what it is on the open market because they have such, dire sanctions, and China's going to buy it. India's going to buy it. A lot of these countries that don't really care what the rest of the world says, are going to buy it. And so their demand is going to go away from OPEC, and OPEC's got their own, they've got their own interests they have to protect, and that's why all oil's always been a boom and a bust. A boom and a bust is because of that ability. It's like, oh, it's up, okay, we're all going to go drill, and then we're going to flood the market with supply. Demand's going to remain constant. Up, there goes the price. Up, no, well, we all go out of business. We're all bankrupt. Up, demand's still staying constant. Supply is way down. Up, we're going to increase supply. Yeah, and it's just this vicious cycle. And so it'll come back down. There's no doubt they'll turn the spigot on. I think releasing your oil reserves is extremely stupid. I think I don't know why we don't flex on Saudi more. It's like they stand no chance in a fight against us, and we have so much power over them. I get they've got a ton of money, but we've got to get them to release more from Saudi Aramco and curb that oil price. Because if not, you know, the Democrats are in for a slaughtering come November during the midterms. It's going to be ugly.
Right. Well, so you're saying that oil is very controlled, which it is. So how is that? Obviously it's different, but how is that different than like the Federal Reserve controlling interest rates? They can go up or down at any time, right? So I mean, I guess it's a little different with inflation, but if rates were to get to 5.5%, why don't they just go drop them half a point?
Yeah, yeah. I think that the difference in that is that the interest rates they're not everything's borrowed. You know what I mean? Whereas everything is transported with oil, right? And so
Right.
the interest rates do affect you at some point, but then there's going to be a certain subset of the population that doesn't really care
Right.
because, like on the investor side, it's like you want to raise them to 20%. And then whenever the prices of everything just absolutely get demolished, then we'll just go buy it all up. And then that's when, that's how the rich get richer, and so whereas everything, oil touches it all, it really does. And so
That
it
makes
hurts,
sense.
painful. But yeah, that's why I think the interest rates, they do have an overall effect on the first time home buyers and stuff like that. But I still think your guys that are doing like your big tract developments, your 1,000 acre developments, the interest rates aren't going to hurt them as bad, especially over the long term.
Yep. Yep. Well, that makes sense. Makes sense to me.
What else you got?
We're almost an hour in. I think I'm good. I don't think I have anything else.
Y'all gonna start publishing these on like Spotify with video? Is that your plan?
I don't know. I think we might that's honestly a good
The All In podcast
idea.
does that. You can watch it on Spotify
Yeah.
and listen to it at the same time.
Like Joe Rogan and Jordan Peterson does that too.
Yeah, it's just really weird when you put it at 2x speed and they're, yeah, bouncing around. Oh, there's
Yeah, I think we'll see. I think we're gonna do it on YouTube for now, and then
okay.
that's honestly something that I should do because there's not like some podcasts do it, but honestly, not a lot of them do it.
No, not many.
And so that might be something that we end up going to.
Just draws you in a little bit more as a viewer or a subscriber. It kind of you get to see what they look like and sound like and their mannerisms, and gives you a little bit more touch to it.
Yeah, we really want to see what you look like.
That's fair. And my fancy gym that's not quite finished.
There
There's my concrete.
you
I gotta
go.
get the rubber
Well,
mats are coming
what we
in.
need to do is get we need to make some type of like a podcast office to where it's like it's actually cool to look at. We got some cool signs on the wall, stuff like that.
Mm-hmm.
So
Yeah, you
I
have
don't know.
to.
We'll see.
All right, I'm
Alrighty,
gonna
well,
work out.
all right, all good. I appreciate having you on here.
Yeah, absolutely, man. I'll holler at you later.
All right.